Welcome to the Deep Dive. We're the show that, cuts through the noise and gets right to the stuff you can actually use. And today we're tackling something that, let's be honest, can feel a bit like wading through mud. Corporate tax filing. But stick with us because hidden inside all that complexity are some genuinely surprising insights and, crucially, ways to save your business some serious money. So have you ever stopped and wondered, are we really making the most of our tax planning here? Or are we just, going through the motions, ticking the boxes? Because our goal today isn't just about staying compliant. It's about finding those real savings.
Absolutely. We've been digging into IRS publication 542. It's the main guide for general tax laws for your typical domestic corporation. So this deep dive, we're going to go through it almost item by item. We'll look at how corporations handle their taxes, focusing on, understanding the whole filing process, but really zeroing in on those potential tax savings.
Right.
How to optimize things. I bet the corporate tax landscape, who, what, when, and how to avoid pitfalls.
Okay, let's start right at the beginning. Who actually gets taxed as a corporation? It's probably broader than you think. We're talking businesses formed under federal or state law as corporations. Simple as that, really. But it also includes joint stock companies, insurance companies, even some banks and government-owned businesses, publicly traded partnerships too.
Right. And it's not just about the name. Think about LLCs, limited liability companies. They're flexible. An LLC can actually choose to be taxed like a corporation. They file a specific form, Form 8832, to make that election.
Why would they do that? Maybe for specific tax strategies or attracting certain investors.
Exactly. It opens up different possibilities. And then you have S corporations, which have their own path-through tax structure, avoiding that sort of double tax. And personal service corporations, PSEs, think law firms, accounting firms, they have unique rules too.
So lots of different flavors, but the basic rule is?
The basic rule, unless you're specifically exempt, maybe like a nonprofit, is that all domestic corporations have to file an income tax return. That's usually Form 1120. And here's the key part. Even if you had zero income, even if you lost money, you still have to file.
Even if you were only around for part of the year or in bankruptcy.
Yep. Still got to file. It's about being on the IRS's radar.
Okay, so filing is non-negotiable. When's the deadline? Don't want to miss that radar ping.
For most companies on a calendar year, it's the 15th day of the fourth month after the tax year ends, so April 15th. Pretty standard.
There's a catch, right?
There is. If your fiscal year happens to end on June 30th, your deadline is actually sooner. It's the 15th day of the third month after year end, so September 15th.
Good to know. And if the date falls on a weekend or holiday?
Then it bumps to the next business day. The IRS gives you that little bit of grace.
And how are we filing these days? Is it still all paper?
Increasingly, no, especially now. For filings after January 1, 2024, if your corporation files 10 or more returns in a year, any kind of returns you generally have, to e-file your Form 1120. You can request a waiver if it's a hardship, but the direction is clearly digital. Better data, more efficient for everyone, supposedly.
Right, efficiency. Which leads us to paying the tax. It's not just about filing the return, it's about paying on time, the whole pay-as-you-go thing.
Exactly. The government operates on this system. They expect corporations to estimate their tax liability and pay it in installments throughout the year.
Like quarterly payments for individuals?
Pretty much the same idea. It prevents a massive tax bill shock at the end and keeps government cash flow steady.
But if you mess up, penalties.
Oh yes, penalties. For filing late, it's 5% of the unpaid tax for each month or part of a month you're late. That caps out at 25%. And if you're really late, like over 60 days, there's a minimum penalty too.
Okay, 5% per month. That's steep. What about paying late?
Paying late is a bit gentler, but still stings. 0.5%, 0.5% of the unpaid tax per month, also capped at 25%.
And here's the crucial part everyone needs to hear. Filing an extension using Form 7004 gives you more time to file.
But not more time to pay. That's a common mistake. Interest starts ticking from the original due date, even with an extension.
But there's a way out of penalties sometimes.
Yes, if you can show reasonable cause for why you were late filing or paying, that's your first line of defense, really. A potential saving right there, avoiding unnecessary costs.
And we should probably mention briefly, there are other, even scarier penalties. Things like the trust fund recovery penalty for unpaid payroll taxes, negligence penalties, even fraud.
Absolutely. Getting the basics right, filing, and paying on time, or having a really good reason why not, is fundamental. 2. Strategic estimated tax payments. Optimizing your cash flow and avoiding underpayment.
Okay, so avoiding penalties is key. Let's talk about being proactive. How do corporations manage this pay-as-you-go system effectively? We're talking estimated taxes.
Right. If a corporation expects its tax for the year to be $500 or more, it generally needs to make estimated tax payments.
And when are those due?
Typically 4 installments. Due dates are the 15th day of the 4th, 6th, 9th, and 12th months of the corporation's tax year.
So for a standard December 31st year end, that's April 15th, June 15th, September 15th, and December 15th. Same weekend holiday rule applies.
Exactly.
Now, how do you figure out how much to pay each time? This seems like where some strategy could come in.
It definitely is. You generally want the method that gives you the smallest required payment for cash flow. Method 1 is simple. 25% of the tax you expect to owe for the current year.
Okay, forecasting. What's method 2?
Method 2 looks backward. 25% of the tax shown in your prior year's return.
Hmm.
But there are conditions. That prior year return had to cover a full 12 months and had to show some tax liability. You couldn't have had zero tax.
Okay, that seems safer using last year's numbers, but there's a catch for bigger companies.
Yes, the large corporation rule. Here's where it gets, as you say, really interesting. If your taxable income was $1 million or more in any of the 3 preceding tax years, you're considered large.
And what does that mean for estimates?
It means you can only use that prior year tax method, method 2, for your first estimated tax payment of the year. For the subsequent payments, you generally have to base them on the current year's expected tax.
So less reliance on the past for bigger players. They need better forecasting.
Or they can use the special methods. This is a huge potential saving strategy. The annualized income installment method or the adjusted seasonal installment method.
Okay, break those down. Why are they important?
They matter because they let you adjust your payments based on when you actually earn the income. Think about a seasonal business, a ski shop maybe, or a summer resort. Their income isn't steady throughout the year.
Right, big Q4, big summer, quiet the rest of the time.
Exactly. So using these methods, they can potentially pay lower installments early in the year when income is low, and then catch up later when the cash is actually coming in. It avoids tying up cash unnecessarily in early estimated payments.
That sounds like a massive cash flow advantage for certain businesses.
It really can be. But get it wrong and you face the underpayment penalty.
And that penalty is calculated per installment period, right? So
Right.
catching up later doesn't necessarily fix an early shortfall.
Correct. The penalty is figured for each due date separately using Form 2220. The IRS often calculates it for you, but you must file Form 2220 yourself if you use those annualized or seasonal methods, or if you're a large corp using the prior year method for Q1.
Okay. What if you go the other way? You overestimate and overpay significantly. Do you have to wait until you file the final return to get that cash back?
Not necessarily. There's a mechanism for a quick refund of overpaid estimated tax, Form 4466. If your overpayment is at least 10% of your expected total tax liability, and also at least $500, you can file Form 4466 to get that money back faster.
When do you file that?
After your tax year ends, but before you file your actual income tax return, Form 1120. An extension to file the 1120 doesn't extend the deadline for Form 4466. The IRS tries to process these within 45 days.
Another good cash flow tool.
Yeah.
And there's a worksheet to help figure all this out.
Yes. The estimated tax worksheet in the IRS instructions or publications can guide you through the calculations, though complex situations might need software or professional help. 3. Mastering deductions and special provisions, the heart of corporate tax savings.
All right, we've navigated filing, deadlines, payments. Now for the part that really feels like finding savings, deductions. How corporations can lower that taxable income figure.
Absolutely. And a great place to start, especially for newer businesses, is capitalizing on the costs of going into business. You don't have to treat all those initial expenses as sunk costs immediately. Corporations can elect to deduct a certain limited amount of startup costs and organizational costs in the very first year they're in business.
What counts as startup versus organizational?
Startup costs are things like investigating the creation or acquisition of a business market studies, travel, consultant fees before you're really operational. Organizational costs are more direct legal fees for drafting the charter, incorporation fees paid to the state, things like that.
So you get an immediate deduction up to a limit and the rest.
The rest you generally amortize, meaning you deduct it evenly over a period of 180 months or 15 years. But that initial deduction is a nice immediate tax break.
Definitely helpful for cash-strapped startups.
Yeah.
Now, let's talk about something potentially huge for established companies. The dividends received deduction. DRD. Sounds technical, but it's powerful.
Extremely powerful. It's designed to mitigate triple taxation, where income is taxed at the subsidiary level, then again when paid as a dividend to the parent corp, and potentially again when distributed to individual shareholders. So, if your corporation receives dividends from another domestic corporation, you can usually deduct a chunk of those dividends from your own income.
How big a chunk?
It depends on your ownership percentage. If you own less than 20% of the distributing company, you generally deduct 50% of the dividends.
Okay.
If you own 20% or more, that deduction jumps to 65%. And there are special cases, like dividends from certain foreign corporations where you own 10% or more, you might get a 100% deduction for the foreign source portion. Small business investment companies, SBICs, can also get a 100% deduction on dividends received.
So significant potential savings just from receiving dividends, but there's a limit usually.
Yes, typically the 50% or 65% deduction is limited based on your corporation's taxable income, calculated before taking the DRD itself.
Ah, okay. But is there a way around that limit? This is where it gets interesting, right? With NOLs.
Precisely. This is a critical planning point. That taxable income limitation on the DRD does not apply if allowing the full DRD actually creates or increases a net operating loss NOL for the year.
Wait, say that again. If taking the full deduction pushes you into a loss, you get the full deduction.
That's right. So imagine a scenario. Your company has a small operating profit, but receives a large dividend. The standard DRD limit might apply. But if your company had a small operating loss instead, taking the full DRD might push you further into the red, creating or increasing an NOL. In that case, the limit disappears and you get the benefit of the entire deduction.
Wow. So an operating loss isn't always purely negative news if you also have dividend income. That loss could unlock a larger tax shield.
Exactly. It turns the NOL into a potentially strategic asset in that context. It's about looking at the whole picture.
Fascinating. What other deductions should companies be aware of? You mentioned below-market loans earlier.
Right, this often comes up in closely held corporations. If a shareholder lends money to the corporation at an interest rate below the market rate, the applicable federal rate, or AFR, the IRS might impute interest. It's treated as if the corporation paid the foregone interest to the shareholder, potential income to them, and the shareholder immediately contributed it back or received it as a dividend. But crucially, if the corporation used those loan proceeds for its trade or business, that imputed interest paid by the corporation can potentially be a deductible business expense.
A bit circular, but the deduction matters. Okay, what about something more common, like charitable contributions?
Always a key area. Corporations can deduct contributions made to qualified charitable organizations.
Who qualifies? The usual suspects: churches, schools, established nonprofits.
Generally, yes. The IRS has lists and tools to check. The timing of the deduction depends on your accounting method. Cash method core deduct when paid. Accrual method core have a bit of flexibility they can deduct in the year the board authorizes it, as long as it's paid by the original due date of the tax return.
Is there a limit on how much you can deduct?
Yes, there is. Generally, the deduction can't exceed 10% of the corporation's taxable income, figured before taking the charitable deduction itself, and also before the DRD and certain other deductions like NOL carrybacks.
Only 10%. What if you make a huge donation?
The excess isn't lost. That's the good news. You can carry over any contributions exceeding the 10% limit for up to 5 years. So you still get the benefit, just spread out over time.
Okay, 5-year carryover. That's helpful. Are there ways to get like a bigger deduction for certain types of donations?
Yes. This is a really valuable point. There's an enhanced deduction available for contributions of certain types of inventory or property. For instance, donating inventory like food for the care of the ill, needy, or infants, think food banks, or donating certain scientific property you constructed for research purposes. For these qualifying donations, you might be able to deduct not just your basis, your cost in the property, but also up to half of the appreciation in value. There are limits, of course, like it can't exceed twice your basis, but is potentially a much larger deduction than just donating cash or writing off the cost.
That sounds like a significant incentive for companies, say, in food production or R&D.
It absolutely is. But record keeping is paramount here.
Always the records. What do you need?
Bank records or canceled checks for cash. For any single contribution of $250 or more, cash or property, you need a written acknowledgement from the charity before you file your return. And for property donations over $5,000, you generally need a qualified appraisal. You have to be able to back it all up.
Makes sense. Okay, moving from donations to losses. What about capital losses? Can corporations deduct those against ordinary income like individuals sometimes can?
No, that's a key difference. Corporations can only deduct capital losses to the extent they have capital gains. If your capital losses exceed your capital gains in a year, you have a net capital loss.
And you can't deduct that excess loss currently.
Correct. But again, it's not entirely lost. You can carry that net capital loss back 3 years and forward 5 years to offset capital gains of those other years.
Carry back first, then forward.
Yes, a carryback first. And importantly, whether it was originally short-term or long-term, it's always treated as a short-term capital loss when carried back or forward. This carryback can generate tax refunds from prior years, which is helpful. Use Form 1139 for a quick refund or amend the prior year returns with Form 1120X.
Okay, so capital losses offset capital gains across several years if needed. What about general business losses, net operating losses, NOLs?
NOLs work similarly in principle, allowing you to use a loss from one year to offset income in another. They're figured much like an individual's, but with corporate-specific adjustments, like we discussed with the DRD interaction. The rules on carrybacks and carryforwards for NOLs have changed over the years, so you need to check the rules for the specific year the loss occurred. But the concept is to smooth out income and losses over time.
And just touching on basics, the choice of accounting method, cash versus accrual, and accounting period, calendar versus fiscal year matters too, right?
Absolutely. These foundational choices affect when you recognize income and expenses, which impacts your tax liability each year. Changing methods usually requires IRS permission via Form 3115, and changing your accounting period needs Form 11128, not casual decisions.
And underlying all of this,
Record keeping. I know we keep saying it, but it's crucial. Keep records supporting income, deductions, credits for at least 3 years from the filing deadline. For assets, keep records related to basis for as long as needed to figure depreciation or gain loss on sale, which could be many, many years. Keep copies of your filed returns too. It's your evidence. 4. Figuring the final tax and leveraging credits.
okay, we've subtracted all the deductions, accounted for losses. Now we actually figured the tax. What's the rate?
For regular C corporations, it's generally a flat 21% federal rate. Nice and simple, at least on the surface. Even for personal service corporations, it's 21%.
Flat 21%. But there's always a but in taxes, isn't there? What about things like SMT? Does that still exist for corporations?
It does, but in a new form for the biggest players. Starting in 2023, we have the Corporate Alternative Minimum Tax, or CAMT. This generally applies only to corporations with average annual adjusted financial statement income over $1 billion. It's complex, calculated on Form 4626, and basically ensures these large companies pay at least a 15% minimum tax on their book income with adjustments.
So for most listeners, probably not an issue, but crucial for the very large core. Good to know. Now, let's talk about the really exciting part. Credits. You called them gold earlier. Why are they so much better than deductions?
Because they're a dollar-for-dollar reduction of your actual tax liability, a deduction just reduces the income subject to tax. So a $1,000 deduction at a 21% tax rate saves you $210.
Yeah.
But a $1,000 credit saves you the full $1,000 off your tax bill. Huge difference.
Okay, dollar for dollar, that's powerful. What kinds of credits are out there?
There are quite a few. The foreign tax credit, Form 1118 for taxes paid to other countries, carryovers from the old qualified electric vehicle credits. Then there's the big one, the general business credit, Form 3800.
General business credit. That sounds vague.
It is, because it's actually an umbrella term for dozens of individual credits: investment credits, work opportunity credits, research credits, energy credits, low-income housing credits, tons of them. You calculate them separately, then combine them under the GVC.
Wow. Lots of potential savings hidden there. Any others?
There's a credit for prior year minimum tax, Form 8827, credits related to certain bonds, Form 8912, and various other specific and sometimes refundable credits. It really pays to investigate what your business might qualify for.
But sometimes credits come back to bite you, recapture taxes.
Yes, that can happen. If you claimed a credit based on certain conditions, like keeping property in service for a certain number of years, and those conditions later change, you might have to pay back some or all of the credit you previously took. That's recapture.
Okay, one last potential tax hit to be aware of. The accumulated earnings tax. What's that about?
This is basically a penalty tax. It's levied on corporations that accumulate earnings beyond the reasonable needs of the business instead of paying them out as dividends. The rate is 20% on that improperly accumulated income.
Why would the IRS care if a company saves its profits?
They suspect the company might be holding onto the cash simply to help shareholders avoid the personal income tax they pay on dividends.
Ah, so how much can you accumulate safely?
There's a general safe harbor amount, $250,000 for most corporations, but only $150,000 for certain personal service corporations. Accumulations below that are generally assumed okay. Above that, you need to be able to demonstrate that the accumulation is for the reasonable needs of the business.
Like what? What's a reasonable need?
Specific, definite plans. Things like documented plans for business expansion, acquiring assets, paying off debt, funding research, having working capital reserves, even redeeming stock in certain situations. Vague desires aren't enough. You need concrete plans. Avoiding this tax is definitely a form of saving. You by understanding distributions to shareholders, avoiding unintended tax consequences.
All right, let's shift gears slightly. Distributions to shareholders. This isn't about saving tax for the corporation directly, but getting it wrong can cause big problems, right? For everyone involved.
Absolutely crucial. Understanding distributions is key for compliance and preventing unexpected tax headaches for both the company and its owners.
So when a corporation pays out money or property to a shareholder, how is it typically treated for tax purposes?
There's a specific order. First, it's considered a dividend, but only to the extent the corporation has current or accumulated earnings and profits, basically. It's taxable income over time, with adjustments.
Okay, so dividends come from profits first. What if the distribution is bigger than the available ENP?
Then the excess distribution is treated as a return of capital. It's not immediately taxed, but it reduces the shareholder's basis, their investment cost, in the stock.
Reduces basis. And if the distribution exceeds both ENP and the shareholder's basis?
Then finally, any amount beyond basis is generally treated as a capital gain for the shareholder, usually long-term if they've held the stock long enough.
ENP first, then basis reduction, then capital gain. Got it. But sometimes things are treated as distributions, even if they're not formally called dividends. Constructive distributions.
Exactly. This is a trap for the unwary, especially in closely held businesses. The IRS can recharacterize certain transactions as dividends.
Like what kind of transactions?
Things we touched on earlier. Making below-market loans to shareholders the foregone interest can be treated as a dividend. If the corporation pays a shareholder's personal expenses, if it cancels a shareholder's debt without repayment.
Selling property to a shareholder way below market value.
That's another classic example. Or paying unreasonable rent to a shareholder for property, or paying unreasonable salaries to shareholder employees. The unreasonable portion can be reclassified as a dividend.
And why does the IRS care about reclassifying these?
Because dividends aren't deductible by the corporation, whereas legitimate expenses like salary or rent are. And for the shareholder, dividends are taxed differently than, say, salary or loan proceeds. It prevents companies from disguising dividends as deductible expenses. Avoiding these constructive distribution scenarios is a huge saving in terms of preventing future tax assessments, interest, and penalties for both the corporation and the shareholders. It's about clean transactions.
And reporting is key here too, I assume. Telling the IRS and shareholders what's what.
Definitely. Corporations generally report dividend payments to shareholders and the IRS on Form 1099 DIV. All the 1099s are summarized on Form 1096 sent to the IRS. And if you make distributions that are not dividends, because you lack ENP, you usually file Form 5452 with the IRS.
Wow, okay. We covered a lot of ground there. So pulling it all together, it seems like the big takeaways are really understanding your specific corporate structure, getting those estimated payments right, maybe using those annualized methods, and then just diligently digging into all the potential deductions.
Right, the dividends received deduction, charitable contributions, especially the enhanced ones, managing losses like capital losses and NOLs effectively, utilizing credits. It's all part of a cohesive strategy.
It's not just compliance, it's active planning. Every item, every calculation can impact that bottom line.
Absolutely. And while we've covered the highlights from Publication 542, this really just scratches the surface. Which kind of leads to a question for everyone listening. How might taking a really deep dive into just one of these areas, maybe a specific credit you might qualify for, or optimizing that dividends received deduction, how would that specifically change your company's financial picture next year?
That's a great question. It prompts action. And maybe a final thought to leave you with. Think about the proactive steps, maybe even small ones you can take starting today. Ensuring your finances aren't just compliant, but genuinely optimized for the future. Because as we've seen, every detail really can make a difference.